We're going to make a quick transition, and if you didn't believe Curtis, then you should. There's a few more people here that want to talk to you about the importance of maritime trade and probably talk a little bit about the Ports Authority. I'm going to introduce Mr. Cliff Pyron, who's our moderator for this panel. And while I'm doing that, if I could ask, I know a couple of the speakers are sitting here, and Greg's coming up, if the panelists could also come up on stage as well and join us here. Cliff Pyron is again, our moderator. He's the Chief Commercial Officer, you can see his picture here, for the Georgia Ports Authority, in charge of working with customers, working with lines, working with a lot of different things that the Ports Authority has to do. Comes from private industry and is a good friend of the maritime industry as well. So Cliff, you take it over, and let the guys give a few minutes of presentation. He's got your order.
Okay, Paige, thank you very much. Again, just to echo Curtis's points, really appreciate everything that Paige and his team has done in putting this program together. It's amazing to me. It's second year that just the kind of reception and turnout that we have for the event. So thanks again, Paige. Cliff Pyron, Chief Commercial Officer for the Georgia Ports Authority. What our panel is going to be here today, we have a great panel of industry leaders with 4 world-class shipping and logistics companies all here today. I'm not going to take a lot of time introducing them. You have their profiles in your bulletins, but just real quickly going from left to right, we have Greg Tuthill, who's a Senior Vice President of Sales and Marketing for NYK Line. To his right is Rick Wen, Vice President of Business Development for OOCL. On his right is Stuart Rattray, Senior Vice President, Southeast for Hapag-Lloyd. And finally, on his right is Bill Woodhour, Senior Vice President of Maersk Line. Really, our panel here today, we're going to address really the theme being what are those areas of concern for the carriers and the shipping industry moving forward. Obviously, there's a lot of challenges here today in the marketplace, and so they're going to address each of this. They're going to take about 7-8 minutes to go through a profile of their organizations, the direction that they're going, share some information with you, and then talk about areas of concern. After each of them is gone, I'm going to throw some questions. I have some questions for each of them, and then we'd like to take any audience questions as well. So with that, I would like to turn it over first to Greg Tuthill.
Okay, thanks, Cliff. Appreciate the introduction. As Cliff mentioned, my name is Greg Tuthill. I'm the Senior Vice President of Marketing Sales for NYK Line. Before I start, this is the first time I've been to this conference, and I certainly appreciate the opportunity to speak and participate in the panel. But before I start, is Curtis Spencer still here from this morning? Curtis, I learned two very important things this morning. One is I will never complain if my daughter ends up marrying a musician. And 2, I think musicians that know eBay probably earn more than shipping executives. So good session this morning. Let me go ahead and get started. I'll take about 10 minutes to go through some slides here. First, I'll just tell you a little bit about NYK, what we do, who we are. And then I've relabeled this a little bit. Paige wanted to make sure we talk about what's working and what's not working. I've relabeled this to talk about the advancements and efficiencies, and then followed by the improvement opportunities or challenges, and then just give you a slide or two on the industry outlook in terms of the maritime sector relative to container shipping. So first, a little bit about NYK. Over 125 years old, so well established in the maritime sector. $23 billion last year in annual revenue, so strong financial strength. I'm pointing out here that the earnings for 2010-11, which our fiscal ended March 31st of 2011, was $944 million. Of course, this year is a little bit more challenging in terms of earning growth, so we'll talk about that in a minute. And we have 5 core businesses within the NYK Group companies. If you look at our profile, our core competency is really the maritime sector. That's really what we do. We own and operate a lot of ships, different classes. For the most part, our focus is on the bulk side, although 23% of our revenue comes from liner operations, and then we have car carrier and tankers, and the energy market too is very big. But really, the last bullet on this slide, I think, is the most important. Our fastest growing segment of our business portfolio is logistics services, and that's why we're here today to talk about some of those opportunities we all have in front of us going forward. I'm not going to go through this in detail, but just to highlight the percentage of revenue based on the business segment, probably the most important is the liner business. We're not fully dependent on the liner business. As you can see, our total makeup of revenue is 23%. In these challenging times, that's a good thing. Just to point out the fact that we're diversified is certainly nice to have in terms of offering that stability. I'm not going to go through this in a lot of detail, but this is our vessel composition in terms of our fleet. Most of the fleet is made up of our bulk side of the business. That includes our LNG and our VLCCs. But we do operate quite a few container ships as well within that market. Here is the revenue for 2011 by business unit. Again, just to point out that our logistics segment is one of the fastest growing and one of the fastest to go ahead and gain earning growth. This is our strong earning growth for the past 5 to 10 years. We did have a problem in 2010, which was really the 09 issues that all of you probably are well aware of in terms of the economy and some of the issues relative to just the consumer demand being off, so that's to be expected. I can tell you this, 2011-12 will also probably be a more challenging close as we continue to go ahead and be faced with some issues and cycle issues with the container shipping market. Let's just talk a little bit about the advancements and efficiency gains within the sector. This is primarily in the container business. Certainly over the last 10 years, we've seen a lot in terms of efficiency gains with the advent of alliances. That certainly has brought down our cost base, improved our efficiencies, certainly broadens our port coverage as an industry while not having the investment constraints that normally you would have if you try to operate independently. So, of course, the biggest thing right now in front of us is the large ships, which have been introduced and deployed in the marketplace. That has brought our slot costs certainly down from what they were previously. However, there's certainly some challenges I'll speak to about that in the next few slides. Some other things to think about in terms of where we're headed. The operations of the vessels in terms of just operating costs, the efficiencies relative to plant design, efficiencies relative to just hull design, that has certainly improved over the last 5 to 10 years. It certainly is not all doom and gloom. I'd rather highlight the positives than the negatives within the business segment. In the container sector, container shipping is not going to go away, so I think there's still a lot of growth left for all of us to go ahead and certainly compete in the business. As fragmented as it is, I think there's still certainly a lot of upside to the business, so that's point number one. The other thing I think that we need to realize is container shipping has brought down the per unit cost in terms of a transportation cost component for most products that we import today. So I think that's also a big gain, and that'll continue to be probably a focus for all of us in and outside the business in terms of a shipping community as we go forward. A couple challenges. I'm not going to go through this in a lot of detail, but the biggest right now is rate stability. We have an issue right now where we've witnessed, I think, a lot of rate vacillation over the years. We really need to go ahead and look at that and think about ways structurally we can change the way we contract and how we do business. Certainly we've got some financial difficulties in front of us as an industry. I think we need to try to address that very soon because we're going to have a problem not only with sustaining service and operating our services as they are today, but also making sure that we can reinvest in the business. I talked about larger ships. The issue with larger ships is they are very hard to scale. They are very hard to go ahead and deploy without disrupting the market from a capacity standpoint, so we just have to figure out better and more efficient ways to go ahead and deploy those. I call this the lost decade. Long story short, I call it the lost decade plus 2. This graph represented that the average freight rate really hasn't changed in the last 12 years. If you look at a trend-based ratio, on average in the U.S. markets inbound, we had about a $1,600 on average dollar rate per TEU, and that hasn't really changed again in the last 12 years. The issue here is we have a lot of supply in the network. We're going to have another 8.3% in the network this year. That's on top of a growth base of about 3 to 4% in terms of the Trans-Pacific. I think the export markets will be a little better than that, but bottom line, we have to figure out better ways to manage our tonnage. So how do we get back to profitability? A couple ways. We need to focus on the core problem. That doesn't mean utilization, that doesn't mean market share, that doesn't mean how big our ships are and how many TEUs we currently deploy. That means how are we going to return a decent return on invested capital ratio for our investors and our stakeholders in the investment community. So that's really what we need to do. We got to think about, before expanding any further, how do we get back to profitability? I think that's the key to the industry right now. We have metrics, and we have a lot of metrics in the business. We tend to have metrics focused on market share growth, TEUs, lift, but we need to get back to core profitability metrics. So the other piece here, and I'll wrap this up so I don't take too much of the time of the other panels here, is we have one thing that's been missing in the last few years. We have done a very good job on the cost side of the equation. We have reduced our slot costs. We have become more efficient. We've had a broader service coverage and frequency in terms of our product offering. What we have not done is really focus enough on the value side of the equation, where we're looking at speed to market, more IT services, and more efficiency in terms of how we're delivering our products to the end user, which are those shippers that certainly engage in contracts with us. So that create value proposition, I think, is an opportunity for us. I think we have a lot to gain if we focus on that. Here's a few other points. I'm not going to go through these, but we have focused time and again on share expansion. We have focused time and again on making sure our vessels are topped off week to week. That has done nothing for stability in the marketplace, so we got to get away from that, and we got to think about better ways to contract, different structures, to go ahead and engage with our customers and look for a predictable model from a pricing and a service stability standpoint. So despite all this, I mean, I think that, NYK is certainly geared to work on that as a smaller niche player. However, it is a collective industrial issue that we need to certainly work towards.
Thanks, Greg.
Thanks, Greg. Good job.
Now, Rick Wen at OOCL.
Sorry, I have to use notes. Paige, thanks for having me. It's great to be back in the South. I spent 15 years of my career. I opened the office in Savannah, and I lived in Charleston. So it's been a good time. I raised my daughters here, and even though they're on the left coast in California, they still consider themselves Grits, girls raised in the South, and they're proud of the association. Anyway, OOCL is headquartered in Hong Kong. We're publicly traded and we're privately held by the Tung family. We're a member of the Grand Alliance, along with NYK and partners Hapag-Lloyd. And we actually pioneered consortia going back to 1976. And it's been a very vital part of our industry today. We operate a modern fleet of 88 vessels with 18 additional ships on order, including 10 13,000 TEU ships. In 2011, our revenue actually dropped down to $5.6 billion, and our volume increased to 5 million TEUs. We have financial stability. We sold 4 terminals and real estate in China to the tune of about $4 billion. I wish I could say we made that money from shipping. We're also a technology company. We developed our object-based global enterprise technology platform as a Y2K solution. And basically, it helps us track shipments everywhere all the time. And we even provide our customers apps that you can use to track your shipments on your iPhones. So just to give you an idea, we doubled our business in 6 years, and we did it within our existing headcount. So that's kind of a strategic advantage and proof that our technology works. We also provide supply chain software under Podium with our OOCL Logistics Group, and a lot of customers like that. Although freight has been trending towards the East Coast and Gulf, in fact, years ago it was 80-20, and it went to 75-25. I think now it's 70%, 30% West Coast to East Coast, and this is prior to the expansion of the Panama Canal. And already Savannah is handling 8,000 TEU ships that are transiting from the Suez Canal. But nevertheless, Long Beach is our biggest throughput terminal in North America. And so we have a substantial amount of skin in the game in terms of investing in the Middle Harbor redevelopment project. We'll invest a significant amount into a $4.5 billion project that will be OOCL's home for the next 40 years. It is green-friendly with electric double-hoist gantry cranes replacing diesel, shore power to avoid running the ship's generators, and extensive on-dock rail facilities to avoid local drayage. It will take 9 years to complete in stages. It will be the most technologically advanced and cleanest terminal in the world. We move the largest volume of finished goods, the greatest distance, with the longest time of possession, yet container shipping represents less than 6% of your logistics dollar, according to a CSCMP study. Long haul and local trucking is over half of your spend, so we'd like to play a larger role, fundamentally. As far as global demand, 2009 was the worst year on record for container shipping. That was as a result of the global financial crisis. The industry lost $20 billion. Conversely, during 2010, demand picked up as retailers restocked their inventories and vessel capacity did not keep up with our customers' demands, and there was equipment shortages, space shortages, prolonged delays, and pricing volatility. So we went from feast to famine and seesaw in terms of supply and demand. So, and additionally, container volumes today are still less than they were in 2006. So based on this development, we've got a great future in shipping behind us. For capacity gains, 2012 versus 2011, gains certainly outweigh capacity withdrawals. In fact, Maersk Line's order book for new ships is about the same as OOCL's entire fleet. As larger megaships leverage economy of scale in the uncertain Asia-Europe trade, smaller vessels will cascade into the Trans-Pacific, North Atlantic, and North-South routes. The potential overhang of available capacity versus demand brings volatility and uncertainty. While OOCL's capacity increased 12% during 2011, our load factors were 5% lower. To give you an idea about financials, 2011 was another year of multi-billion-dollar losses for the industry. While OOCL results look promising for the first half, and I feature them prominently, in the fourth quarter, our revenue dropped a whopping $700 million. We'll be lucky to eke out a small profit this year. Average revenue per TEU declined 7% at a time that operating costs increased 7 to 8% due to transportation and fuel. So clearly, if you want to make a small fortune in shipping, start with a very large fortune. Ships are getting bigger, and these are pretty accurate scales. Curtis talked about an 8,000 TEU ship's advantage over a 4,500 TEU ship. These 13,000 TEU ships have a 30% lower cost per TEU than an 8,000 TEU ship. So smaller ship operators are leveraged out of the market by competitor ships with larger scale of economy, and small shippers are unable to make margins at lower costs. For areas of concern, cost and market volatility, 2011, our costs increased about $250 a TEU. Every aspect went up. It was fuel, it was transportation, it was terminals, and it was also the currency factor. While slow steaming reduces fuel costs, it's largely offset by adding more vessels per string to maintain weekly services, albeit at slower speeds. The outlook for the global economy is uncertain. Only the transatlantic and intra-Asia trades are improved or remain stable for OOCL. Poor customer forecasting is another issue that helps us achieve asset utilization, and we really need to communicate more effectively with our customers in an open sharing of information so that we can meet your demands. Fortunately, OOCL's technology platform provides us visibility into our dynamic cost structure right down to the component level. But the light we see at the end of the tunnel may well be a train coming the other way. This is a chart that maybe Greg wanted to feature, and basically what it shows is revenue. Well, what I'm trying to describe here is revenue versus bunker cost comparisons. So while 2009 represented the lowest point of revenue per TEU, 2011 wasn't much better. If you see here, this is the low point of revenue, but you notice bunker cost was also low. Over here in 2011, the rates are higher, but look at how much higher the bunker cost is. I would say that the difference is almost the same. So we're looking at a real rough year for last year and potentially a future. As far as the wish list of what's important to us, continued globalization, eradication of protectionism and tariff barriers, aligning vessel capacity to meet demand outlook with quicker decision-making to synchronize our activities, the ability to share information with customers and peers openly, transparently, and responsibly, stability for the market with sustainable pricing, clarity of commitment with customers to deliver as agreed so that we can identify what your expectations are on the front side rather than trying to make the rules as the game is being played. If you need extra free time, if you have a preferred trucker, if all of these types of, if you have unnatural gateways, we need to identify this so that we can really craft and customize our relationship in a contract that makes sense for both of us. And we also want to play a much larger role in your supply chain. We do move the most, the furthest, for the longest period of time. There's got to be something in there for us to explore. What I see on the horizon, we see that we're moving from from just in time to time definite. When you consider the cost of moving goods, air freight might be dollars per kilo. Ocean freight is pennies per kilo. Postponement and near sourcing, customization towards the end of the supply chain. More rail intermodal versus long-haul trucking, especially post-Panamax. 53-foot containers are very popular now, and I think people were talking earlier today about having smaller, more frequent shipments. Well, we have all the sizes. APL's already offering 53-footers. We've got 45-footers. We've got 40-footers. We used to have 35-footers. We've got 20-footers. So that's something that should be explored. Reduce empty positioning costs. A really significant amount of money is spent. I would say at OOCL, it's $200 million a year just moving empty equipment around. And we have a domestic transportation company that moves 700 empties with domestic cargo every week. So those are just some thoughts, and look forward to talking to you some more. Thanks.
Appreciate that, Rick. Thanks. Next, Stuart Rattray, Senior Vice President for Hapag-Lloyd.
Thank you. And thank you for the opportunity to speak with you and for us to prove that there's no such thing as a free lunch, as you have to sit through these slides and listen to four guys from the steamship industry talking about the financial woes of their industry. As I sat there, I was wondering how Cliff chose the order of the speakers, and I wondered if it was alphabetical, but that didn't work. I wondered if it was age, but you can't ask your age in the US, and that wouldn't be very good for Bill's to my right. I wondered if it was geography. I'm the only guy that's actually a local guy, and you can tell from my accent, I'm from Kennesaw in Georgia. But that actually leads to what's really exciting about being in logistics in Georgia. Curtis explained about the growth and the potential for the catchment area. And for me, I've been in it all my life, and I love it just because it's global. Every day I get the opportunity of maybe dealing with one of our 114 offices throughout the world. So moving on just to a brief a brief glance of what Hapag-Lloyd is, and similar to the other lines, 82 services around the world, 142 ships. We've got an order book with 10 new ships of 13,200 TEU. We operate about 1 million TEUs of containers. We've got 300 offices around the world in 114 countries and 7,000 employees. Moving on to strengths, and what we look at is differentiators, a very heavy customer orientation. We're decentralized, so we can be closer to the customers. We have a global presence. I talked about the number of offices. We do pay a particular attention to special cargoes, whether they're out-of-gauge cargo, hazardous cargo, and reefer cargo. A heavy focus on sustainability. Our people make a difference, and then customized e-solutions. So we were asked to talk about what's working and what are the challenges. And I've taken a slightly different approach, maybe from the first two speakers that talked very much about the big picture industry. I wanted to bring it down a bit. And when we talk about what's working and what's not working, when you read the press and you listen to various comments, you get the impression that not a lot is working. Yet last year, the industry moved about 120 million TEUs, and they did it successfully and efficiently. So there is a lot of things that are working. So I'm not going to spend my time talking about demand, capacity, world peace, some European debt, oil prices, but really more about how we need to navigate to get through the volatility that exists in our world today and very much impacts on the supply chain. Winston Churchill had a good saying, which was, "I always avoid prophesying beforehand because it's much better policy to prophesy after the event has already taken place." So division and dissension makes a good story. By the way, I've taken a minimal approach on the PowerPoints, like Steve Jobs, just keep it to a minimum. Division and dissension makes a good story, but from where I sit, there aren't a lot of adversarial relationships with shippers. A lot of it is very good partnerships and a good understanding of one another. I talked about the fact that we're decentralized to be close to the customer. We also have a multi-level cell, so there's different touch points throughout our organization and the customer. We've attempted to reduce volatility and introduce stability through longer-term contracts based on transparency, reciprocity, good faith, and a proven record of relationships and partnerships. Quality. I counted the number of additional services that our customer service people provide on a day-to-day basis. I came up with about 20. A lot of those are now becoming the norm and things you need to do to stay in the game. But we have personalized service, own sales, dedicated points of entry, own e-business solutions, escalation points, statement billing, specialized reporting, proactive sales, proactive customer service, strict service levels, key performance indicators, benchmarks, best practice, and continuous improvement. Some things on sustainability. As a responsible carrier, we've been in the forefront of sustainability. We were the first shipping company to derate the main engines on its vessels so that we can adjust to the speeds. The first shipping company to operate main engines with electronic injection controls to ensure clean combustion. Another first was what we call the thrust fin, which is installed between the propeller and the rudder. Special smooth silicon coatings lower friction, while trim software makes sure the ship sits in the water to minimize resistance. We've just launched a new eco calculator, which not only calculates the production of emissions of carbon dioxide, but also nitrogen oxide, sulfur dioxide, for a container movement from one location to another through the system. And then efficiency. Over the years, we continue to take redundancy out of the system whilst not reducing the services we provide. But each year, that becomes more challenging. And then the comprehensive e-business solutions I talked about to deepen the customer relationship, increase the data quality, streamline and speed up the processes. So then moving on to what's concerning, it's all the same things. And I should offer one disclaimer, and that's as I go through what's concerning, it's very generic, and each customer is very different. A BCO is different to an MVO. A wholesaler is different to a retailer. And an importer is different to an exporter, but we all play in the same sandbox. So with relationship, notwithstanding the comments I made about what's working, there's always space to improve. And a lot of that is partnership, and that's probably a word that's used far too often, maybe not as often as game changer and thinking outside of the box. But as with most things as well, there's expectations. What are the shipper's expectations? And one of the previous speakers talked about just in time. There is a movement maybe to just in case because of the volatility of weather and so forth. I had one instance this week where a customer said they had to stop their plant because a door move was a couple of hours late. Well, if you're operating on that thinner margin and there's no flex in the system for a container coming from China to a location in Texas, I think that's cutting it a bit fine. Quality. There's still a lot of management by anecdote. Decisions need to be based on fact and data. Scorecards. Scorecards are very beneficial. I have a number of customers that do scorecards on my performance or my organization's performance. But maybe we should think about 360-degree performance evaluations so that we look jointly at how we're working together and what can be improved. Sustainability, all the things I talked about in terms of sustainability come at a cost. So as we move to reduce emissions, reduce fuel, the vessel designs improve, then vessel costs increase. And then somewhat linking into what Curtis was talking about, I talked a lot about the innovations for our vessels. We're also innovating with container manufacturing, trying to match truck moves to reduce emissions. But the US infrastructure in particular is a cause for worry. Poor and neglected roads, bridges, the issue of dredging, and so forth. Efficiency, I talked about the e-business solutions, yet the penetration in the US is only at about 50%, which is sometimes far worse than other places around the world. Other challenges, free time, containers earn money while they're moving and we need them back. Booking cancellations cause rework and swings in vessel allocations. No shows cause problems. Forecasting. And forecasting is a challenge for our customers. But are we sharing the information we have? Inflated forecasts, uneven flows. So overall, I've painted a picture where progress is happening, but there's still a lot more to be done. Stuff happens, whether it's weather, economic, political, or this issue that the other speakers have talked about supply and demand. But it's all about continuous improvement to jointly smooth volatility and achieve greater predictability and stability. I know at Hapag-Lloyd we have a number of targets, a lot of ground to move, but we have a lot of aspirations as well. So thank you very much for your attention.
Thank you, Stuart. And finally, Bill Woodhour, Senior Vice President of Maersk.
Thanks. There's another benefit to going forth. You get that special look from Cliff that says, move it along. So I'm going to try and walk through a few pastures. I'm going to tell you a little bit about Maersk Line. We're going to study some of the issues or opportunities facing the industry, and then what we can all do about the opportunities and issues in front of us in this room. Real quick, we've been around for a while. A.P. Moller Maersk, founded by Arnold Peter Moller in 1943, turned over the company to his son, Maersk McKinney Moller, who is still active at 98 years old, going to the office every day to find out what's going on. We're two parts to our business, basically an oil and gas company and a liner shipping company, both about 50-50 on the revenue side. The profit side goes up and down year to year. Headquartered in Denmark, have about 500 container vessels, 1.9 million TEUs moved throughout the year. Liner shipping, real quick, I think the other folks have done a great job describing the industry that we're involved in. It is a relatively young industry. It's become the standard for connected trading partners between different geographies. And throughout the 50s, 60s, 70s, 80s, and 90s, it experienced rapid growth. On average, over 10% annual growth per annum, which is significant. In 2009, that all halted, as illustrated before by Rick, experienced negative growth, and going forward, we see a change in the growth patterns that will affect the industry and will affect how the industry operates. Tried to figure out how do you describe the volatility that we see in our industry. It's been talked about before by some of the panelists, so perhaps the graph did show up. A picture is worth 1,000 words. This is taken from our financial statements. It's from 1995 through 2011, full year. It basically is an indication of our freight rates on a global average. We operate in different geographies. Many of those geographies are stable. In the east-west trades, they are even more volatile than what you see here. The important takeaway from this is two. The frequency with which the volatility is occurring is becoming more rapid. It's shorter periods. It's higher and lower within a condensed period of time. The other is the magnitude of the volatility. When you look at this from a customer's point of view, you have to explain why are your costs rising or why are they decreasing so significantly. For a carrier, this is the revenue line. I'll talk a little bit more about the investment community and what they see, but this is a major issue for them going forward. If we take a look and circle back to the growth patterns are changing, not just as a consequence of the 2009 global economic recession, but because the market is starting to mature in the east-west trades, we're seeing a significant change in growth patterns. We're estimating that multiples of GDP of 3 and 4 will no longer happen in the major east-west trades. Why is this significant? If you look at the average carrier's asset deployment for a global carrier, it's 55% of all assets are deployed in Asia, Europe, and Trans-Pacific. Some are as high as 70% within that industry. As these patterns start to slow in terms of growth, you'll no longer be able to go out and buy assets, ships at $100 million plus each on a speculative basis. You used to be able to do that when you were growing at 10% a year. When you're growing at 2, 3, and 4% a year, you're going to have to come up with the money first and be very certain that you'll have utilization of those assets. There's a sameness of service offerings in industry dialogue. When you've gone through and it's been talked about the economy of scale, VSAs, the product offering that's come out from carriers to pursue all that, to get the right scope of coverage, to get the right economy of scale, the service offerings are becoming blurred. The industry dialogue is focused around, do you have a service, what's my capacity commitment, and the price. In certain trade lanes, you can argue it's become commoditized. The investment communities are indeed becoming disillusioned. I've had the opportunity to meet recently with two of the major investment companies, and I've got their little list here so I don't forget anything, but I think it's important for us to understand the view from the people who are putting money into this industry. The first thing they point to is the volatility slide, and they ask, you want me to buy you a 25-year asset against that chart that goes up and down? The second is to say, in your major areas, growth is slowing. Everybody talks about the emerging markets. It's the CEO playbook. If you're not playing in the emerging markets, you're not there. It's volatile. It's not steady. You can't even rely on the data that says if you grew 10%, did you actually do it? Yes, it's an opportunity, but it's not going to bail out the fundamental change that's happening in a lot of the East-West trades. They say that your industry is driven by short-term market changes in long-term assets. It has too much of an effect, what's happening in the short-term market, on your revenue lines against the long term. Fragmentation, there's an index out there known as the HHI index, measures industry consolidation. It goes on a scale of 0 to 2,000. Ocean shipping is at 800, right alongside airlines and the auto industry. Two areas not attracting a lot of capital investment these days. Price to book ratios. If you look at the industry overall, the price to book ratio is 0.7 to 0.8. You put $1 in today, you wake up tomorrow, we've instantly secured 80 cents for you. Debt capacity, when you look at the credit ratings of companies, they're declining. When you look at what they backed up debt with in the past, it was assets. You can have these ships as collateral. That has been exhausted. The price of capital is increasing. We've seen people in our industry offering debt at a coupon rate of 30%. The average right now is about 15%, which is up 3 or 4 points. So it's becoming more and more expensive to stay in this business. Essentially what they described, and they both use a similar analogy, they said that what they see in the future is either going to be this continued yo-yo effect, boom and bust years, you'll make a lot of money one year, you better save it because you may lose it the next years, or they call it the zombie effect, where everybody's just going to continue doing what they're doing until they run out of cash. So what do we do about that? It was mentioned before, I think Stuart just mentioned it. When we look at who uses this industry, when we look at how critical this industry is to your supply chains and your distribution, different customers and different needs. Run through before, importer, exporter, dry, reefer, frozen, fresh, high-value commodity, traded commodity. Nobody in this room has the same needs for our industry. What we have to do is engage in different dialogue to find out what is that difference that truly matters to your business and what can we do about it. That dialogue requires different people at the table, expanded stakeholder groups, port authorities, suppliers, people within your organization who handle domestic. What are the fundamental needs for your business, and how can we develop a service and product offering to meet those needs? There is an opportunity within our industry to take what could be a cluster of sameness and break it out into differentiated service, which, sure, there'll be a low-cost solution if you have goods that don't need to be there at time definite. And then there'll be a group of carriers offering products that are differentiated that can meet your needs and look beyond the traditional supply chain. So everybody plays a critical role in this. I think what we have to do in this period of transition, which I'm confident that we're in, is make sure that whatever we do, we create value for your company, for the industry going forward, so we can both become more competitive. So with that, I just encourage everybody that as we go through this transformation, think a little bit differently. Quoting Einstein is never a risk. Using the same problems, you can't solve the same problems by using the same kind of thinking we use to create them. So with that, Cliff, I'll turn it back over to you.
Well, thank you very much, Bill, and everybody on the panel. I'd like to ask Curtis to come up and join the panel. We've got about 15 minutes left. Then we'll take a break and then go to the next session. So I have some questions for the panel, and then we're going to have a running microphone that's going to be coming around, and we'd like to take some audience participation questions as well. So, Curtis, if you could come up and join us, that'd be great. And we're going to switch out the mics here and have a microphone to hand to everybody when we're going around and asking questions. You know, we talked a lot about stability and predictability and how important that is for the carriers. There's been, you know, just a lot of talk about that the last couple of years, just that these gaps are just continuing to narrow with these highs and lows of the industry. And the industry is in a fragile state. There's no question about it. I'd like to put it out to the group first and perhaps go to Bill first. I mean, what have been really, Bill, in your opinion, what are the most significant changes for carriers today, and what do you think can be done to remedy the situation? We talked a little bit about forecasting here the last couple of days. What role do you think that plays? What can be done differently?
Is a lot what the other speakers have pointed to in terms of the financial pressure that's hit the industry. And the biggest challenge today is understanding what is the product or value they want to bring to the marketplace in the future. Companies have to make a decision what type of model they want to employ going forward. I'll give you a quick example. I've heard a lot about slow steaming. Some people like it, some people less so. But they say with slow steaming should come better schedule reliability. And the allegation goes out to say, well, you fall behind on your ship schedules, you should speed them up, burn more gas, and go forward. Well, it's not a consistent action in the industry. Some carriers look at it to say, well, speeding up the ship costs a lot of money. That's a carrier who's focused on cost. There's other carriers who would say, schedule reliability, that's important to my customers. How do you then make sure that each company is clear on where they want to create value within the industry, what customer that appeals to, so that the product consistency is known and that it's truly delivered upon what their proposition is?
Thanks. You know, just there's been a lot of talk here lately, and you'll see it in magazines, newspapers all the time in our industry. Talk about the value of long-term contracting as perhaps there a way that you can take this unpredictability out by doing long-term contracting. I'd just like to throw this question out to Greg and get your view and NYK's view on the value of long-term contracting. Are you doing that with more and more customers here today? Do you see that as a potential trend for perhaps improving the health of the shipping industry?
I think one issue is technology. We just witnessed that, but you know, back to the question. I think that you were asking about value and service, and long-term contracting, how that plays a part in value and service. We have, as NYK, engaged in a few long-term contracts, which have proven to be successful from a stability standpoint and also from a planning horizon standpoint. So I think there's value in looking at that structure, and it's not new. We've been doing some of this in our bulk contracts with NYK. Back-to-back contracts are longer term, and certainly it drives stability. So I think there's more opportunity in the area of longer-term contracts. I think we've talked about index-based contracts and just long-term fixed-rate contracts. You know, whatever works, I think, is worth exploring, but I think there's opportunity there, Cliff.
Question for Rick. We talked about the importance of forecasting, and we're just at a conference together here the last couple of days, and just talked about that as being the criticality of forecasting to a carrier in engaging with their clients, both retailers, importers, and exporters. And Rick, I'd just like you to comment on giving your views on how important forecasting is to the process, to a carrier, and what value that brings to both the customer and to the carrier.
For shipping, our efficiency is achieved through asset utilization. So there's really four things that drive our business. Externally, it's supply and demand. Internally, it's economy of scale and asset utilization. If you have big ships, full ships, you can make money. As far as forecasting is concerned, every time we do not profile a vessel in a buoyant market, it's a missed opportunity. It's not something that can be regained. So in a buoyant market, customers who want to protect space will hoard space that maybe they won't use. And there's perhaps 3 or 4 other customers standing in line that would love to have that space. So it's really an issue of communication and understanding needs on both sides. So one initiative is certainly to penalize customers who either do not provide forecasting or do not perform when they make bookings. But we'd like to be a lot more proactive than that.
And for Stuart, because you all providers of ocean transportation, are there any new industries? Are there any industries out there that are doing well? And whose shipment counts? And what areas of industry are growing in this environment and with the kind of clients that Hapag-Lloyd is doing business with, Stuart?
Hey, Hapag-Lloyd's technology works. I mean, we see growth across the spectrum, particularly in exports, as we've heard from Curtis, the way the throughput through Savannah's occurred. Pulp, paper, agricultural products, those sorts of things. Obviously, the automotive industry has bounced back. So anything associated with that. It's just keeping an eye on what's going in the marketplace, what's happening with our customers, potential changes in the retail industry. Through the recession, we saw the dollar stores increasing. But then the changes in distribution patterns from distribution centers moving to fulfillment centers, as there's a move from bricks to clicks. The whole world is just changing so rapidly, and so many of these things in the retail industry. And that generates changes then in their supply chains and what they're looking for from us.
Thanks. We have a few minutes left. Any audience questions for any of our panelists? Yes.
Gentlemen, if slow steaming is permanent and here to stay, what are your customers telling you about how their supply chains are going to be affected, and how can you respond to their concerns if this is becoming a permanent part of the landscape?
Slow steaming, and Bill may be able to speak a bit more about it, but certainly it does introduce extended time, but is that time built into the system? And I also talked about the different customers that we have, and looking at both import, export, retailers, and so forth. So the impact is different on different customers, but it's more about predictability than an extra day or an extra 2 days.
I would largely echo your comments on the benefits of predictability and reliability should be the outcome of it. The stubborn fact is, when you look at the operating costs and the variable expenses associated with operating a vessel, fuel is the majority of your expenses. Slow steaming could be unwound tomorrow, but rates would have to go up significantly. Bunker fuel, as illustrated in one of the charts, is topping about $750 per ton. Back in the days of quote-unquote faster schedules or normal schedules, you were looking at prices between $175 to $225 a ton. So this significant increase has become a cost factor, and then there's also environmental benefits that go alongside with the slow steaming of it. So we've had a number of requests to say, can you offer a faster service between points A and B? We've had wide open dialogue to say, yes, here's what it would require in terms of additional fuel consumption, here's the additional cost for that service. And people have given us opinion one way or the other on that. So I think that's part of the transparency and the dialogue that we need to create going forward.
Another
I'd like
question,
to
is the
add
microphone
that
working now?
it's also a function of sustainable profitability. I don't think that there's been significant degradation on the Trans-Pacific eastbound, for example, in terms of slow steaming. We do more slow steaming on the westbound side with heavier export cargo than we do on the eastbound side. But if there's fog in Shanghai and we're losing money already, there is no incentive for us to maintain schedule if we're just going to burn through money faster. I mean, what we're talking about is a really dire situation. It's a war of attrition. When we're looking across the carrier landscape, it's a matter of who can bleed the least and last the longest. Slow steaming is going to be pretty much here to stay because I don't think oil prices are coming down anytime soon.
I think we have time for one more question.
Yeah, I think it's working now. We heard a lot about the ocean carrier industry and about the volatility in the marketplace, certainly about the financial stress on the ocean carrier industry because you're so asset laden. But I haven't heard much about pricing stability. I mean, it's not all of us in the room here, importers, exporters, freight forwarders, 3PLs, NVOs, that are pushing these rates downward. We'd like to see a little more discipline on the carrier side from a rate stability standpoint, and maybe you guys can give us some comments about what we can do to have the rates be a little bit more stable, allowing everybody to engage in what I believe to be longer and fairer term contracting and not play the peaks and valleys of our industry. It just seems to be a bit crazy these days.
Greg, I'm going to let you take that one on.
Oh, thank you. Yeah, pricing is certainly on the forefront of everyone's mind, whether you're a shipper or a carrier. And you know, one thing I can say to the question about pricing is we really need to think about different structures going forward. I don't have the solution necessarily today, but you know, longer term, I think we have to change that contract structure to allow for stability to be entered into the arrangement with the shipper and carrier. You know, one thing that we could start looking at, and we have, is these longer-term contract structures. I think make a lot of sense. I think, though, we have to have some provisions in the contract that make sure there's consequences for adjustments along the way, both on the carrier side and the shipper side. So this idea that I mentioned earlier, back-to-back contracts that are longer term and structured, I think certainly there's an opportunity there to go ahead and to use those to strive for stability.
I want to thank our panelists for being here today. I want to thank you all for your time and attention through the lunch. Let's give all our panelists a hand. Thank you.